Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, June the 1st. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. So having that out of the way, let's get this on. We have a lot of economic data to go over in the form of PMI, which is Purchasing Managers Index. And Purchasing Manager Index is basically the purchasing managers for the manufacturing side looking to purchase raw materials to manufacture something. So usually when they are pretty bullish to the upside of the economy, I guess, if you will, then they're going to be looking to purchase more materials for producing goods. When it goes below 50, though, that's when it's starting to signal a bit of a retraction in the economy because their outlook isn't that good. So anything above 50 shows expansion in the economy. Anything below 50 shows contraction in the economy. So having said that, we had the Spanish manufacturing PMI come in at 51.8, slightly below expectations. The Italian PMI came in at 52.4, but lower than expectations. We had the German PMI come in at 52.1, so slightly lower than expectations, just by a smidge. And then we also had the PMI numbers here in the United States, which was in the form of Institute for Supply Management. So that is the final number for the PMI. And with that, we had here in the United States the final PMI numbers at 50.7, so just above the waterline there. And the ISM side of the manufacturing PMI came in at 51.3, so above 50, showing expansion. The one thing that we saw that wasn't looking so good was construction spending, and that came in at negative 1.8%, was expected to be a positive 0.5%. So that was a bit of a wet blanket on the overall data points that we saw today. We also saw ISM manufacturing prices paid come in higher than expected, surprisingly higher than expected at 63.5, and that was expected to be 58. So quite a bit higher there. Probably mostly in part due to higher crude oil prices. As you can see here, we have crude oil coming back strong after being down quite a bit today, looking to try and get into positive territory, just down 6 cents on the day, but back into that $49 a barrel area. This morning, it looked like it really wanted to go back down and test this value area that I've been talking so much about. So that whole settling above $50 a barrel, the bulls have not given up on this market at all. And the overall turnaround in crude oil is reflected in the overall equities. They seem to be still lockstep right now. NASDAQ /NQ up almost 3 points on the day and pushing quite a bit higher. E-mini S&Ps just moving into positive territory here, as you can see, back and forth basically right now. They were just in positive territory, but right there at unchanged, trading at 2,094. So NASDAQ pushing a bit higher, leading the way, following right lockstep with crude oil. On to the breakdown of the E-mini S&Ps, as you can see here on a 15-minute chart. Basically, after the data points we saw this morning coming out from here in the United States, the overall markets really started pushing quite a bit higher off those data points. And with that, a couple of trades that I've done with Gap here, which is ticker symbol GPS. I decided to go in there. It looks like it's found a pretty good bottom. The overall retail sector has really been beaten up just with bad earnings and Amazon doing so well. So a lot of these retailers got beat up, but it looks like Gap may have found a bottom here, and I decided to just go in and sell some puts. So I went into the July, sold the 16 puts for 30 cents. So that is below the overall low that we've seen, and if the retailers get even just a smidge of a bounce, I'll be able to cover that, and looking to take about 50% of my max profit, so take about 15 cents out of that. On to YHOO, I talked about this yesterday. I had on the June 32, 34, 41, 43 iron condor, and I originally sold it for 64 cents. I was able to buy it back yesterday for 28 cents, so did a little bit better than the 50% the max profit there. So usually I'd look to cover it about 32 cents, but the market really came in for me yesterday and ended up covering it. Might be able to do it a little bit better today. It looks like the overall market in there is went down and tested this value area where the most volume has been traded. On to SLB, which is Schlumberger, the ticker symbol SLB. I ended up getting this one off yesterday, and I did this because this was in part due to the webinar that we did on Friday, which was on call diagonals. And I did it with the August, bought the 67.5 calls, and then to help finance the extrinsic value of that option, I sold the June 80 calls. And I'm looking to have those June 80 calls expire worthless, and then that leaves me long the August calls for just the intrinsic value of those. And I ended up paying $9 for that trade. So I'm hoping to see Schlumberger, it's a bullish to market neutral type of strategy. It's bullish in that, or I should start off with, it's neutral in that we want it to trade sideways and not really ramp up and test those 80s necessarily rather quickly. We'd rather see those 80 calls decay and expire worthless, and then have that upward momentum in Schlumberger going forward. So that one is a strategy I talked about. It's pretty difficult to build around the calls, but we're going to be doing this week on the puts. So the puts are a little bit easier because there's a little bit more premium pumped into some of those puts, and it'll be a little bit easier to find a strategy that works for the put diagonal on that one. All right, so that's about all I got for you guys today. I didn't end up getting my LinkedIn yesterday. That one just didn't work out. The market just got away from me and wasn't able to get a fill at the prices that I wanted. So $10.50 was about that 75% the width of the strikes that I talked about in the webinar. So you can go to protraderstrategies.com, sign up for the put diagonal. Definitely a little bit easier strategy to put on rather than the call diagonal. The call diagonal takes a lot more work, so it should be a really good one. I think a lot of people got a lot out of that, and my rules don't really follow the rest of the curve, but I give specific rules as to how to set this up, whereas if you just go online, you're not going to find that anywhere else. All right, that's all I got for you guys today. If you can't take that, take it easy.